Good afternoon and welcome back to the latest edition of the InvestTalk market analysis for the week ending July 26, 2024. Now, I am on vacation out on the Big Island of Hawaii, so audio might be a little different, a little echoey. I'm in a large office here, but today's video I still want to get to, and today's video is going to be titled "Yen Carry Trade Unwind Kneecaps the Nasdaq." And there's a lot to be discussed here right now. And I love this heat map here. It's going back 1 month. I'll even do 1 week. I'll start with 1 week because obviously I do this week to week. But you can see here is all the big cap tech names just down. And that's Tesla down 11, Nvidia down 6, Apple down, Meta, Eli Lilly, Visa, MasterCard, just all these names. Amazon's really the only large name that's this week did okay. Everything else was pretty much down, even Netflix down 4%. So the bigger the name, what you can see here is look at the green as you get lower. Let me refresh that real quick. Look at the green as you get smaller. Smaller means smaller market cap. So it's clear that the mega caps are the ones that are getting, as the title of this video says, kneecapped. And you can see on a monthly basis that's the same. Not quite as stark, but still Google, Microsoft, Meta. Only Apple of the big names is up, Tesla as well. But everything else, even Eli Lilly, Merck, Visa, and MasterCard, all down mid high single digits for the most part over the past entire month. Okay, and that's a theme that you have to recognize. And especially, if I zoom out to a 1 year, here's the Morningstar style box. What you can see is large caps are still outperforming those small and mid caps over a 1 year time period. But you run to a 3 month. 3 months, it's not a short period of time anymore. You're starting to extend out here. And what you can see is small caps are outperforming all, whether that's mid, when that's value or value or growth, that's still outperforming what you're seeing on the large cap side. And same with let's go to the 1 month. It's even more stark. Large cap growth now down 5% over the past month, whereas small cap value up 7%. And that is what is of note, okay? And in a second, I'm going to show you the yen because that is the most important thing that is happening in the markets right now. But first, let me get to the economic data. I'll just run through this real quick. Richmond Fed manufacturing on Monday, negative 17, the lowest level in 3 years, right? More than that, 5 years. Okay, you're getting back to levels during the COVID crisis. So Richmond Fed manufacturing side not doing too hot. Existing home sales down 5% month over month. That's existing home sales. So obviously the higher interest rates not really helping there, and you're not getting a lot of traction in demand. New single family homes sold, that also ticked down once again for the second straight month. Still kind of hovering in the 600 to 700,000 on a monthly basis. You have durable goods new orders month over month that did accelerate nicely, so that was kind of a bit of a positive. Total vehicle sales though, and this is X transportation. Okay, we have to exclude transportation because there was a hack, one of the major softwares that run a lot of the dealer networks in the United States in June, and the back half of June you see that's why you see this big dip in total vehicle sales. So you kind of have to throw I think those two numbers out because there's a lot of you have to at least throw this number out, but you have to use the X transportation because that includes the cars. So that did find a bit of strength. Fed manufacturing, that also was at negative territory, very similar to the Richmond, but just shows you the manufacturing side of the economy remaining relatively weak overall. Continuous claims for unemployment, that did tick down a bit, so it showed the jobs market maybe improving slightly, but still kind of in an uptrend there, and in general a weakening jobs market. And then the core PCE, 2.6%, the 12-month mean trimmed PCE. These are two numbers the Fed really looks at, both continuing to head lower, although not near. You're still not at 2%. I guess you could call it the ballpark, but not really, right? Still two handle, but we're closer to 3 than we are 2. So despite that, the Fed is looking to cut rates in the month of September. That is very likely. Here's consumer sentiment also ticking down a bit as well. But ultimately, you're going to get a Fed cut in the month of September unless something wild changes. We have the Fed meeting coming up next week. They're very likely to do nothing. That's a 94% chance they'll do nothing. But as usual, they will probably message, as former Fed Chair Jim Dudley came out and said something like, hey, we need to cut rates. And so there's now there's actually 11% chance there's 2 rate cuts between now and September. So there's going to be one in September, barring anything drastically different about the overall economy that would actually push it back to the upside. But right now, continue to see things that remain relatively weak, and expect rates to start coming in over the next couple of quarters. And this ties into the yen carry trade. Now, I have this chart up. I might as well talk about it before I get to the yen, but this is small caps to the Qs. And what you can see here is, and I can zoom back out, this has been in a downtrend for a long period of time. This means that the Qs were outperforming the small caps. Now, you had a pause here, basically of 2022, when this rallied. Okay, when small caps outperformed the Nasdaq. Nasdaq was down 33%. The small caps are still down, but not nearly as much, and that rallied. Ever since really the fall, when liquidity got better, fall of 2022, liquidity started getting better. You started to see the Nasdaq outperform once again. The yen carry trade back on, and you're starting to see this reverse. And now, I very well think this could be a big move, just because of the extended underperformance of small caps to the Qs. And there's a couple of dynamics here. Obviously, Qs are over-owned. Okay, here's the Qs. Right, you're starting to see a bit of reversal here. Look at the MACD not making new highs. A lot of divergences there that you certainly have to watch out for. And now we're hit the 100-day moving average, but we did that already once. Remember, when you get to a support level, that is less likely to hold the next time. And I do think this will break. And a lot of it has to do, let me get to the yen. Here's the yen carry trade, right? So how the yen carry trade works is those that are running this trade is they're shorting the Japanese JGB. It's costing them a certain percentage, usually 0 to 1%, somewhere in that range. And they're going to buy higher yielding assets of some type. Mainly right now, the safest bet is the treasuries, right? Yielding 5%, go relatively short duration. And as long as the yen does not appreciate by 2, 3, 4% over the time that they're holding this trade, then that spread between the cost of borrowing the yen as well as investing in the income you get from a treasury, that difference is somewhere in the neighborhood of 4 to 5%. And so as long as you don't get the yen strengthening, you come out profitable on that trade. And a lot of times they use leverage, and that's a big part of this trade. But what's happening is the yen has been falling so much. If I zoom back out to a weekly here, and what you see is, look how precipitously this yen has fallen. Okay, this is at 92 back in 2021 when the Fed started raising rates, right? Fed starting raising rates in 2021 or 2022, actually, that's when this really accelerated. But the market was basically signaling this was going to happen by the yen being in that downtrend going into the rate hiking cycle, and then it really accelerated the downside. So the yen has fallen about 33% versus the dollar over the past 2+ years, 2.5 years, call it. That is a lot. Okay, that is a lot, and that's creating inflation in Japan. And so what they need to do is figure out, okay, how do we deal with our debt situation, which is worse than ours? Their demographic situation is obviously poor, but they control their own currency. So they can continue to print, they can continue to keep rates low, but it's going to depreciate the currency and create inflation in their economy. And that's what's happened here. Well, what you see now is that they're talking about defending their currency, as well as the Fed talking about cutting rates. So the difference between what it costs to borrow in yen and the return you get on treasuries, for example, that is going to shrink. And the market's obviously going to start front running that. And a certain number of carry trade investors are probably going to cover that, and they don't want this to get too far out of hand, right? And so that's what you're starting to see right now. Now, it doesn't mean that those yen carry traders are always buying treasuries, though. I use treasury as an example because it's pretty straightforward, right? Short-term treasuries yielding 5%. What they can also do is they can also invest in things like the Nasdaq, in tech stocks, okay, with that borrowed money. And obviously, that's more volatile. And those are actually probably the first ones to cover the yen carry trade, right? Because it's very difficult for treasuries to go down, right, in value, especially the short-term treasuries, okay? So they're not really worried about downside volatility there. But in tech stocks, in just equities in general, and obviously the tech stocks, the Nasdaq is the most crowded trade, they are most at risk of dropping precipitously and turning a positive carry, should we call, into a negative carry. When you get a negative carry, now you can blow up a hedge fund, you can blow up an entire fund, right? And so that is what is happening now, and that's why you're seeing, look at the yen, okay? When did the yen start going up? That was pretty much the beginning of July, okay? When did the Nasdaq peak? Right, a little bit after that, right? So yen started depreciating, and then those within the net that may be holding tech stocks, Nasdaq stocks, they started to worry, start to unwind some of their positioning, and that created a sell-off in the queue. So if you continue to get this dynamic of Japan trying to support the currency, the Fed trying to cut rates, that is a recipe for a carry trade unwind and selling of the Nasdaq and just the over-owned names of those that might be executing that particular strategy. So that is, I try to make that as simple as possible, but that's kind of what's happening in markets right now and why you're seeing this big movement. On top of that, you're getting those lower rates, right? The Fed trying to cut rates. The big tech names, they tend to have a lot of cash, okay? And what are they doing with that cash? They're buying treasuries, right? They might be buying, they're probably not buying 7 to 10 year treasuries, but they might be buying short-term treasuries, like an SHY, right? Or an SGov, right? 1 to 3 month treasuries. Things that are very low volatility, but getting good yield. So they're actually benefiting from higher rates in many ways. So if those rates get cut, guess what? They're not going to benefit as much. And on top of that, small caps, they tend to be, have not as quality businesses, not as quality as of balance sheets, excuse me. And so if rates go down, what does that mean? It means that they can suddenly borrow money cheaper. Okay, here's short-term high yield bonds. They're strengthening, means there's more demand for them. It means that some smaller companies are able to refinance their debt at a cheaper rate. So the dynamics that are starting to emerge are positive small caps and negative mega caps. And that's why over the past month, you're seeing that big divergence. Okay. And this is the story likely of the second half because I don't see the Fed reversing and going back to talking about more rate hikes or higher for longer, right? They're pretty clear they're looking at cutting rates sometime this year and probably twice, right? Market has potentially 3 rate cuts priced in between now and December. Now that could ebb, go back to 2, and suddenly, might strengthen the dollar a bit and weaken the yen a little bit, and maybe that brings a little more life into the yen carry trade. But if that's not the case, if they do plan on 2 to 3 cuts this year and then prognosticating more cuts next year, and the yen or the Japanese central bank is trying to strengthen the yen or keep it steady, suddenly that yen carry trade could continue to unwind, and that would be a big news within the markets and continue this shift in policy, okay, and shift in markets, okay. Let's get into some other aspects of the market. I always want to kind of go over the MOVE index, moving up a little bit. That's still really not an issue. So the treasury market, that looks fine, at least for now. Commodities have been pulling back. You're seeing weakness in copper most of all. Oil, a bit of weakness, but it's still holding kind of the low 70s on WTI. So as long as that's the case, I think I'm still relatively bullish on energy. I don't think we're going to get to 120 anytime soon, but Fed goes through a rate easing cycle. If we get a Trump presidency, which remains the likely outcome at this point, despite the shift to Kamala, a weaker dollar and more domestic demand is likely ahead. So something to keep an eye on there. Real estate, here's the REITs. Those continue to find some strength as well. So anything that is going to benefit from a Fed rate cutting cycle. Those are looking relatively strong. Utilities here, that's pretty strong. Here is industrials, right? Those are strong as well. A lot of mid and small caps in the industrial space. The banks, here's the KBE index that is breaking out. So these are smaller banks that are going to benefit from a rate cutting cycle and domestic manufacturing growth, for example. Those have been strong. AIA, this is, sorry, the IAI, there we go. This is the broker-dealer index. So you're looking at Morgan Stanley, Goldman Sachs, investment banks. They would benefit from looser financial conditions, maybe more issuing of debt if rates fall. So they get a cut of that. More M&A activity, for example. So those that's finding some strength as well. And also a lot of mid and small caps there on top of that. Let's look at the broader indices. So here's NYSE. That's showing some relative strength as well. Here's IWV, Russell 3000. This one's a little more weighted towards those tech names. And so looking a bit more weak than those broader indexes like the NYSE. Here's XLK technology that continues to, like I said, hit that 100-day moving average, likely headed to 200 at this 200-day moving average. So we'll see what kind of reaction we get there, but I definitely see some at least near-term weakness in the tech stocks. What else do I want to get to? Let's go to gold and silver. Gold, a little pullback this week, but overall this is kind of in a consolidation period, and obviously a rate cutting cycle will certainly help the precious metals overall. Silver, a bit of a setback, so something to monitor there. But here's GDX, the gold miners, and those remain relatively solid as well. Overall, we're in a rotation market, a market that's likely to be choppy. Here, let me go to there's materials, right? That's finding kind of consolidation, looking to strengthen into next week. But here's the S&P. My base case is that we get some volatility, at least down to the 51 to 5200 area before the quarter ends, mainly driven by those mega cap tech names. Okay. And if you look at some of them, you're definitely seeing some weakness. Amazon below the 100-day moving average. Let's look at Google. That's at the 100-day moving average. Microsoft, certainly near support, so getting a bounce, but I could easily see that breaking through the downside in the near term. Apple's definitely the strongest of the bunch here, just above the 50-day moving average with a bit of a pullback. Netflix, that looks like it's weakening. You can see that trying to break that 100-day moving average to the downside. I think that's likely. And then lastly, Tesla. Tesla had that big surge higher, but on earnings moved lower. And so what's interesting is it did make a lower high. So I think that's likely the case going forward. NVIDIA also continue to roll, and I think that will head to the downside most likely. So that's kind of the markets right now. Rotation remains intact, and as we go into the Fed meeting next week, obviously that will be the catalyst along with earnings. NVIDIA earnings, I believe, are next week or the week after, so that will be a big factor as well, considering the size of NVIDIA. I'll end that there as we head into next week, and I'll give you my assessment next weekend. All right. Appreciate you all tuning in, liking and subscribing to this video, and reminder that this video is for educational purposes only and should not be construed as a recommendation to buy or sell security or to participate in investment strategy. The views are my own and do not represent those of KP Financial or those associated. Have a wonderful weekend.